who believes that the euro will fail in some form or another and will not be around anymore in the next 5 to 10 years? Okay, so you're all contrarians. Very good. So let's take a look at what really happens in the run-up to the monetary union. Because officially the EMU started only in 1999. But as you can see here, European yields came down already years and years before the euro really started. The reason was that people anticipated convergence in the Eurozone, and not only convergence, basically what was built into the market was that yields came all the way down to German levels, because there was an implicit expectation that Germany would kind of guarantee the other European debt, even though in the European Treaty there was an explicit clause which prevented any bailouts. But nobody ever believed in the no bailout clause from the beginning. So that's why yields came down to German levels, and also Greece only entered the EU much later. So in the beginning it was the core Euro countries, and everything went well for many years. The US debt bubble started to implode, the Great Recession took off, liquidity dried up, and the whole Ponzi scheme was exposed. So what happened then, suddenly Greek and Ireland's yields started to explode again, and now we have a situation that yields are reflecting individual country risks again within the Eurozone, but still we have a fixed exchange rate. And the implicit guarantee by Germany is gone, because the markets have realized the problem is so huge now that even Germany won't be able to bail out the rest of Europe. And the so-called core of Europe, which used to be Germany, France, Benelux countries, France basically is also in deep problems. So it's really only Germany left. And why the exchange rate matters? You can see here, if you look at these numbers, this is basically the GDP deflator in different European countries. GDP deflator, as you know, is a different measure of price inflation. And in Germany, over the last 10 years, the GDP inflator went up only about 11%, so roughly 1% a year, which was thanks to ex-Chancellor Schröder's reform of the labor market, where Germany went through a long period of basically no real labor wage growth and became competitive again. But what happened at the same time, in Greece, GDP deflator over the last 10 years went up by 34%, 33%. And in many other European countries as well, even France. I think by today the numbers are even higher than here. France is also up 30%. So, of course, you could assume that maybe productivity in Greece has improved by 30%. Quite unlikely. So what really happened is that none of these countries did anything about their productivity, but their price inflation went up. And now you have a total disconnect between Germany's productivity and the rest of Europe. And the problem now is that we have a fixed exchange rate, because previously, before the euro started, this chart goes up to 99. European countries always devalue their currencies. That's the usual easiest tool politicians choose to deal with economic imbalances. Just devalue the currency, happened frequently in Italy, everywhere. And that's how these countries regained their competitiveness. And the problem is now that we don't have this devaluation tool available to them. And little theoretical background explains it all. Usually when you economists are not really good at making predictions. They can explain perfectly what went wrong after the event. But here's one example of the optimum currency area theory by Robert Mundell. He established in 1961 and later got a Nobel Prize. You have, as a sovereign country, you have three major parameters to control your economy: interest rates, exchange rates, and debt issuance. And in a currency union, that actually works, you don't have these tools left anymore. And to make a currency union work and sustainably work, you need to have certain conditions which in Mandel's theory are fleshed out. That's labor mobility, capital mobility, wage flexibility, some fiscal transfer mechanism, and a similar business cycle so that the interest rate policy by the common monetary authority works for all the countries. So if you look at the European countries, you might have similar business cycles, that's true, and capital mobility is there. But labor mobility clearly doesn't work. There's too many language barriers, bureaucratic barriers, pension systems are different, so people don't easily move within the Eurozone. Wage flexibility is not there, at least wages are not flexible to the downside. And there's no fiscal transfer mechanism because it was never established in the first place. And that's the big design error in the European system, that they started a monetary union without having the fiscal union in place. Of course, politicians hoped it would sort itself out over time, but that never happened. So if you close all these tools and safety valves in a monetary union, the only tool left to deal with economic imbalances are transfer payments. And that is exactly what's happening now. Bailouts, transfer payments. So the question is, what can happen from here? What are the possible scenarios? One, of course, is transfer payments. Permanent transfer payments could theoretically work, but that's not even an option anymore because the problem is now so big that even though I'm sure this would be a very popular measure in Germany, it's not even possible anymore. So you can forget about that. Fiscal union is actually the solution. If they can establish a fiscal union, it would make the single currency zone long-term work and sustainably work. And the big question is now, can it work? If not now, it will never work. But now, under huge pressure, it might actually, there might be an opportunity to put something in place. And Germany is working on this behind the scenes. Austerity, of course, is another option. Unlikely to work in countries like Greece. And it wouldn't even solve the problem, because as much as Greece, Italy, Spain need to adopt some austerity, right now it would only make the problem worse, because the economy is already down. It would kill off whatever is left in the economy. The only country where austerity is working is Ireland, but it's a totally different case, because Ireland's debt problem was not a sovereign debt problem in the first place. It was a banking problem, which became a sovereign debt problem when the government decided to save all the banks. And Ireland has put in place credible austerity measures, and they have, over the years, made themselves competitive by bringing down their costs. The other countries, Italy, Spain, yes, they need to implement austerity, but it's a fine line they're walking between austerity and killing off the economy. What about defaults, exits from the Eurozone? Defaults we have already in Greece, whether or not you call it technically a default, but of course everyone knows it's a default. And I believe Greece, over the long term, might also exit the Eurozone. Probably not now, because again, the Greeks themselves don't want it, and nobody wants to create more uncertainty and pandemonium in Europe. So for now, I don't think Greece will exit. But long term, when things have calmed down, they might as well exit the Eurozone, because even if they default, they will solve the debt problem for now, but it doesn't make Greece competitive again. The only way to become competitive would be a massive, probably 30% currency devaluation, or they have to really get their act together. We'll see about that. Breakup of the euro, that's of course what everyone expected, and of course things are still not stabilized, so I believe there will be setbacks over the year where panic might break out again. People think the euro will completely break down. But I'll tell you in a minute why that's not going to happen. And there's always the option of printing money. And so you can guess which routes politicians will take. And you got it. Of course, they take the path of least resistance, as always. This is the ECB balance sheet. The gray line is the Fed balance sheet, which we all know. But the ECB effectively has engaged in massive quant easing through the back door recently. As much as Mario Draghi has been insisting that the ECB cannot and will not print money like the Fed, that's correct technically, because they cannot print money out of thin air. But what they're doing is they're giving banks unlimited loans, 3-year loans at 1% interest rates. And if that's not stealth quant easing, I don't know what it is. Meanwhile, the Fed never stopped printing money, they just stopped talking about it because it became politically unpopular. And they even printed money for Europe through the dollar swap facility, which then gets channeled into the European banks as well to provide dollar liquidity. So while people have been speculating about if and when QE3, QE4 might start, it's already there. It's quant easing has gone global now. It's global quant easing in the Western world. And what happens if you print money and combine that with permanently low interest rates and negative real interest rates, that's the most potent formula for a higher gold price. And we've had this for the last 10 years already, and as Ben Bernanke has assured us last week or 2 weeks ago, that low interest rates are going to stay at least for another 3 years, and in Europe as well. If you have inflation of anywhere between 3 and 6%, if you would calculate it properly, it would be much higher anyway, and interest rates between 0 and 1%, you have negative real interest rates anywhere between 0 and 4 or 5% in the UK, all across the Western world. And what that does is negative real interest rates. This is the single best correlated factor which drives up the gold price. Actually, of all people, Larry Summers has done a paper on what's called Gibson's paradox, which academically explains the correlation between negative interest rates and the gold price. It has tons of other reasons why gold will continue to go up, but this is the most potent and most reliable factor. So in summary, what's going to happen this year? My main message is the euro will not fail.